Today in this video we will talk about the institutional funding candles, a key concept that reveals the hidden manipulation behind market moves. These candles are the footprints of institutional money, and mastering them will help you align your trades with smart money, rather than falling into their traps and becoming a victim of manipulation. But that's not all. I'll also share a powerful trading plan built around institutional funding candles that has the potential to skyrocket your win rates. So, be sure to watch every part of this video carefully. We'll break everything down step by step, giving you all the tools you need to fully master IFC candles. We always appreciate your support, so please give this video a thumbs up and subscribe to our channel if you are new. We all know that market manipulation exists, and will always exist. Institutions and smart money are often the driving forces behind this manipulation, which causes losses for many retail traders. But here's the key. The market is fractal, and smart money cannot completely hide its footprints. As a smart money trader, your goal is to spot these footprints to align yourself with institutional money rather than being on the opposite side, which often leads to losses. One of the most effective ways to identify these footprints is by correctly recognizing institutional funding candles, IFCs. These candles represent manipulation plays in the market, and properly analyzing them gives you a perfect edge in predicting the market's next move. Now, let's start with the basics. What IFC candles are, and how to identify them on a price chart. So, what is an institutional funding candle? An IFC is a candlestick, or series of candles, that clears noticeable liquidity above or below a major structure. These candles are formed during market manipulation, where liquidity is taken out just before a sharp move in the opposite direction. In simple terms, an IFC occurs when price takes out a key structure, and then quickly returns to the range of that structure, before continuing in the smart money's intended direction. To easily identify an IFC candle in the market, you need to follow these steps. Here's how it works. Identify candles with large bodies or long wicks that stand out on the chart. Look for a sweep above or below a key level. This is where liquidity is taken before the market reverses. After the liquidity grab, confirm the reversal with strong displacement in the opposite direction, indicating a shift in market structure. Why are IFC candles important, and how can we use them? IFC candles are crucial because they represent the footprints of smart money in the market. These candles manipulate price by taking out retail traders' positions and highlighting areas where large volumes are traded just before a sharp move in the opposite direction. These candles mark zones where smart money artificially enters to clear liquidity, initiates the remaining portion of their positions. When the price returns to these zones, it often reacts and reverses in the opposite direction. For example, here's a common accumulation scenario you'll often see in the market. The price consolidates between a high and a low, which act as strong support and resistance levels, with multiple tests of both areas. Then, the price breaks below the support level with a large red momentum candle, grabbing liquidity beneath the support. Immediately after, the price rebounds above the support area with a bullish engulfing candle and rapidly pushes toward the buy-side liquidity above the resistance level. It's crucial to understand that the liquidity below the support includes two types of orders. Stop-loss orders from traders who entered long within the accumulation zone. Sell-stop orders from traders expecting a breakout below the support level. Since the price experienced a manipulation phase, there is an IFC candle attributed to this manipulation. In this case, it refers to the large red candle, as it is the last selling candle that grabbed the sell-side liquidity before the drastic bullish reversal. From an SMC perspective, the psychology behind IFC candles differs from classic models, like accumulation or consolidation phases. Unlike traditional AMD patterns, you simply need to identify when price sweeps liquidity above or below a supply or demand zone, and closes back within that zone. This indicates manipulation and presents an excellent trading opportunity. For example, in this scenario, the price sweeps the liquidity below the most recent major low and its associated demand zone. It then immediately reverses direction, heading toward the buy-side liquidity, aligning with the market's overall direction. IFC candles typically form in such scenarios, offering trading opportunities in 2 steps. After sweeping key sell-side liquidity, the price often moves toward buy-side liquidity. This interaction can be used to set up a trade model. IFC candles can be treated as key areas, like supply or demand zones, with a high probability of price reacting and reversing when it returns to these zones. Now, let's dive into the details of my favorite trading plan for trading IFC candles. In a bullish market profile, if the price pushes below a major low and its associated demand zone on a higher time frame, forming a potential IFC candle, and then immediately returns into the range of the demand zone, this is a key signal. At this point, we should quickly switch to a lower time frame to analyze the price action closely and look for reversal signs and potential entry opportunities. Once we identify an IFC candle and confirm that manipulation has occurred, we can proceed to execute our trade. For placing an entry, we have 2 options to consider. The first entry model involves waiting for the price to form a lower time frame PD array, most commonly a mitigation block, to open a position. In this case, a buy position. Place your stop loss a couple of pips below the PD array. For take profit levels, you have 2 options. Target the nearest draw on liquidity on the current time frame, or aim for a higher time frame draw on liquidity for larger potential gains. In the second entry model, wait for the price to reach the highest or lowest point of the higher time frame IFC candle. Then, place a limit order at the 50% Fibonacci level of the IFC candle. In this case, a buy limit order. Place your stop loss a couple of pips below the IFC candle. Now, let's move to a real chart, put these concepts together, and see how to use them to execute trades. Here we have Euro-Dollar 30-minute chart displayed on the screen. As you can see, the market's overall profile is bearish, since the price has created multiple bearish breaks of structures to the downside. If we take a closer look, you'll notice that the price grabbed the buy-side liquidity above this major high with a large engulfing candle. On its way up, it also swept the liquidity above these equal highs. After taking out this liquidity, the price has now returned below the range of the major high. This candle is a strong candidate for being an IFC candle. The next step is to mark the highest and lowest points of the 30-minute IFC candle. Then, I'll zoom into a lower time frame, in this case the 5-minute chart, to look for potential confirmations and entry opportunities. Now, with the 5-minute chart on the screen, the goal is to patiently wait for the price to form both a market structure shift and a 5-minute PD array. Once these conditions are met, we can look for an entry to go short from the 5-minute PD array. As you can see, the price continues to drop, confirming the IFC candle. Here, we notice that the price has created a market structure shift and formed a PD array. Which in this case is a mitigation block. The sequence is clear. A swing high, followed by a swing low, then a lower high, and an immediate reversal. It's important to note that this differs from a breaker block, as a breaker requires the formation of a higher high, not a lower high. These last 2 down close candles represent the 5-minute PD array, which is the mitigation block. I'm setting my entry at the lowest point of the mitigation block and placing my stop loss just above this swing high. For take profit, you have 2 options. Target either the closest 5-minute sell-side liquidity, which is located here, or target the 30-minute time frame sell-side liquidity, which is over here. I'm opting for a more aggressive approach by targeting the 30-minute time frame swing low, offering about an 8-to-1 risk-to-reward ratio. Now, let's play out the trade and see what happens next. As you can see, my order has been triggered, and the price is pushing downward with strong momentum. Finally, the price has successfully reached the take profit level. Now, let's move on to another example to further solidify this concept. Here, once again, we have Euro-Dollar 30-minute time frame displayed on the screen. As you can see, there's a large engulfing candle that sweeps the liquidity above the previous major high. This large engulfing candle is a strong candidate for being an IFC candle. I'll highlight its highest and lowest points, and then zoom into the 5-minute time frame to search for any potential reversals and confirmations. Now, on the 5-minute time frame, we need to patiently wait for the price to drop into the IFC candle's range, confirming that a manipulation phase has occurred. As you can see, after sweeping the buy-side liquidity above the major high, the price immediately reverses its direction and returns into the range of the major high. This gives us the confluence we were looking for. However, for additional confirmation, I'm going to wait for the price to reach the lowest point of the IFC candle before taking any further action. Now that the price has reached the lowest point of the IFC candle, I'm going to draw a Fibonacci retracement on the IFC candle and set a sell limit order at the 50% level. I'll place my stop loss just above the highest point of the IFC candle. For the take profit, I'll target the next sell-side liquidity below this swing low, providing a 4-to-1 risk-to-reward ratio. As you can see, my order has been triggered, and we are officially in the market. Eventually, the trade played out successfully and reached the take profit level. That's it, traders. Thank you for watching this video. I hope you found it informative and useful. Don't forget to hit the subscribe button and turn on notifications to stay updated on our latest videos. We value your feedback and suggestions, so please leave your comments below and let us know what topics you'd like us to cover in our future videos. We appreciate your support and look forward to seeing you in the next episode.